A new report focused on trends changing the landscape of the Nigerian banking industry was released today in Lagos. The report, published by Proshare, a leading financial information and research organization, presented a macroeconomic review of the country, as well as an outlook on what investors and market professionals should look out for. Let's take a listen to Tosin Ige, who is Proshare Head of Research, and Teslim Chitobe, Managing Director and Chief Economist at Proshare on this.
What we can say about the global economy, if I can sum it up in one word, it is what? Risk. And so let me move to the Nigerian economy. Now, the presidential plan suggests a pro-market policy across the policy action if you go through that. But of course, if we review the 1 year, what we have between this same period last year and now, what we observe is that the situation has become dearer for us as a country. And so let's focus on the trilemma. Focusing on the trilemma, we'll see that inflation, when we look at the inflation, the interest rate, and of course the exchange rate, all has become dearer. But of course, to better give us an understanding of the state of play, what we did is actually a pested analysis, and then of course this is also, we did it in two, looking at the current reality and then the outlook, and we also have the policy response. But of course, the pested analysis that we have here, in terms of the politics, yes, we are able to achieve our 9th democratic transition, but of course, you and I know that trust deficit is still on the rise. And of course, again, the disenfranchisement that we see, of course, is notable in the economy now. And of course, when we look at the economic aspect of it, the trajectory of growth is still on that rate. When you look at the social bond, was stretched during the election and is still there. In terms of technology, we are seeing the evolution of AI and other technology driving financial institutions, and that's why it's a major composition of our report this year. And then when you look at the environment, we think the global economy, yes, there is that climate change on the global economy, but we think actually that we are overstretching it for Africa. For a country like Nigeria, it's not really a major consideration for us. And then the legal system, yes, it's there, but of course, it's complex, yet it is not supportive of business. And then insecurity at this period is there, but we dare say that it is actually underreported, because we still have food insecurity, we have insecurity of pipelines, and we have even cyber insecurity. All of them are there. But of course, these are the current reality in terms of the pested analysis. But as I said, we have the outlook. I wouldn't like to go through the outlook because of our time. We have the outlook, and of course, again, we also have the policy response to it. But to sum it all up, let's look at our outlook for the macroeconomy. What we are seeing here is that if the current policy ambiguity continue, these are the likely outcome that we feel we will likely see. And if we get it right, and that on the other side is what we feel the outcome will be. But whether we get it right or not, I think 2023 is just, it's not ending. So, but of course, if we get it right now, we're likely to see those positive outcomes in the coming year, 2024. So that's basically what our outlook is. And then let's move quickly to the sectoral review. Now, in sectoral review, we actually have 3 metrics for measuring the sectors that perform well. Of course, the growth of the sector, the contribution of the sector, and of course, the employment capacity. As of now, we still put them in equal proportion, but of course, work is ongoing on how to, properly weigh them, to understand the sectors that are performing well. But based on data, this is still the sectors that we see that are doing well. And in terms of that, that's why we bring our outlook to say, based on the performance, and of course, these 3 metrics I've mentioned, the growth, the contribution, and of course, the employment capacity, we're saying that these are the sectors that we see to be driving the growth of the economy. Financial services and telecom are all there, but of course there is a low-hanging fruit for the youth, which you see many youths into. That's the entertainment. So that's our outlook for the sector. And then if you agree with me, everything has changed, even the sector. This is a completely new market. You see the dominant sectors in the 80s and 90s. But here is the change that we've seen in terms of our market, in terms of our sectors now. You see, in those days, Union Bank, Lever Brothers, Nestle, USC used to be the dominant. But here is what we have now. The financial services, the telecom, the cement companies are the sectors that are growing now. And these are the sectors. And that's why, again, I've said the telecom and the financial services are all intertwined. They're like twin now. We've seen the telecom company moving into the financial services, and of course, so that's why they are the major sector that we feel will drive growth.
So whether you're tier one or not was mainly about your size. Now, if you see the screen, you'll see that capital adequacy 15%, asset size at that time, 2013, was a minimum of 1 trillion naira. Currently, AfriInvest has revised that. It's currently 5 trillion naira. And you have to have a deposit of about 2.5 trillion. That's the AfriInvest model. There was an emphasis on non-performing loans, liquidity, asset size, and capital adequacy. However, while we were doing some research on the Nigerian banking sector, we realized that there was a need for a revision. What actually is a tier one bank? And why is tier one bank static? AfriInvest introduced an interesting concept, FUGAS. FUGAS was an acronym for First Bank, UBA, Guarantee Trust Bank, Access Bank, Zenith Bank, and Echo Bank. But that categorization was static because for 10 years we had the same banks being categorized as FUGAS, Tier 1. While we were doing our analysis, we said, wait a minute here. We are seeing some challenges with having a static metrics for Tier 1 banks, and we decided to tweak the AfriInvest model a bit. Yeah, so we did our first report in 2021 with 6 criteria. But as in all things in Nigeria, there was a feedback. And we decided as Proshare that that feedback was relevant. So the feedback talked about needing to broaden the criteria for assessing what a tier 1 bank is. First and foremost, people felt, look, why are you using absolute figures? Why aren't you using percentages and relative figures so that we can see how important the bank is in terms of its efficiency? They also pointed out the limitations of the original ranking in 2021, that it was not evolutionary. It didn't take into account how banks were evolving, the emphasis banks were now placing on different other areas. A quick one here. I'll say this quickly while we discuss. If you will notice that the bank balance sheet is a different animal today than it was in the past. Most of the banks today have balance sheets that are tilting towards off-balance sheet activities rather than off-balance sheet activities. Subsequently, FBNH got out its data for the full year, and then they moved up from 12th position to 8th position. But they were still in tier 2. I need to emphasize that they were still in tier 2. But a better tier 2, from 12 to 8. So we decided metrics improvement. Non-performing loan ratio for FBNH dropped from 7.3% we calculated earlier to 6.1%. The capital adequacy ratio rose from 15.5 to 17.4. And then broad diversity. Because of some of the issues that we're all aware of, they decided that they needed to improve their management structure. And when I'm talking about management, I'm talking about governance structures. And so we saw more women come in, and so diversity metrics moved from 10% to 20%. Right, now enter the period 2022. In 2022, we decided that we were going to add a few other matrices. We needed to capture risk, we needed to capture assets, because we pivoted a bit from AfriInvest. We felt, okay, AfriInvest was too heavy on assets, so we should maybe tone down assets as a matrix. However, again, as a result of feedback from CFOs, they felt, no, the assets still are important. So we still brought it back in. So we have that there. Then we had asset quality. Then we now brought in profitability, efficiency, cost to income ratio. I see some of the bankers are nodding their heads. I understand why. Right, so digital income and then governance. Now, governance, what we did in governance was to introduce the independent non-executive directors. And we used that as a proxy for improved governance. Of course, we could argue other matrices, but this is what we used for 2022. How do I know whether I'm a tier 1 bank? Now, these are all the matrices we used, 10 matrices we used for 2022. Now, we use the percentile method. And before we got to this percentile method, we did something. One of the things we did was this. Some of us who are maybe statisticians will recognize the concept of a panel econometric model. What we did was to be able to identify coefficients, and those coefficients across 3 years and across banks, so that we can get those coefficients we will attach to each of these variables. And that was the basis of our percentile rating for each bank.